Hello and welcome back to my channel. Hope you enjoy my previous videos. In this video, I'm going to talk about why moving average is a good indicator for trading, different periods professional use to make profit, important steps required to enter the stock market, important steps required to exit the stock markets, and finally, I'm going to share with you a few examples to clarify the trading strategy. In this video, I'm not going to talk about history or tedious calculations since I explained clearly in my previous videos. Instead, I'm going to show viewers how to enter and exit the market at the right time and be able to trade with this indicator like professional. And through various practical examples, you will be able to gradually strengthen your portfolio and assets. Why moving average is good for trading? Because moving average is both simple and effective for beginners. It is good to spot changes in price and trend detection. It generates trading buy and sell signals. Combining two moving averages produce crossover strategy. It creates an excellent dynamic support and resistance levels, which changes with the trend. Different period professional use to make profit. I recommend you to install different periods such as 5, 10, 20, 30, 42, 50, 60, 100, and 200 days using simple moving average and exponential moving average in your price chart and see which setting you are more comfortable with and contain prices the best. Cliff Duke, the author of Moving Average Simplified, used the 10 and 20 setting and also 30 and 60 setting of periods in his price chart and produced good results. Some others may use 10 and 42 days in their trading, where 10 represents 2 weeks and 42 represents 2 months of trading. Let's see some examples. This is Yahoo Finance and Air Canada stock 1D time frame. Each candle represents 1 day of trading, and this is the price chart. On this price chart, I install different moving average with different period. For example, here is 5 days. Here is 10, 20, 30 days, 42, 50, 60, 100, and 200 days. You see, as the number of period becoming bigger, the curve or moving average open itself and the distance between that moving average and the price chart becoming bigger and bigger. Whereas here 200, the distance is very far from the price. And 5 SMA, the distance is very close to the price chart. This is Yahoo Finance and Air Canada stock and 1 week time frame. Each candle represents 1 week of trading. And I just want to show you what is the behavior of different moving average with respect to price chart. This is the price chart that you see. And I installed 200, 100, 60, 50, 42, 30, 20, 10, and 5 days of moving average. So we see as the period becoming bigger, the distance between moving average and the price charts becoming bigger. And so this is the behavior of 1 week time frame. Crossover strategy. One of the most popular use of simple moving average is crossover strategy. Using moving averages with long time periods such as 50, 100, and 200 days provides better performance in stock market trading. The greater the number of time period, the smoother the average will be. Buy or sell signal is triggered once the smaller simple moving average crosses above or below the longer moving average. For example, if we install 50 and 100 days period and the 50 days crosses the 100 days while going upward, this intersection is called golden cross. And if the 50 days crosses the 100 days while going downward, the intersection is called death cross. Although moving average is very strong in crossover issues, while we have a strong upward or downward trend, but we have to remember that this indicator has a poor performance in sideways trend and horizontal range or neutral market. Important steps required to enter the stock market using SMA 50 and 100. First, the trend must be in upward direction. Second, the price chart must be above the slower moving average SMA 100. And finally, the shorter moving average SMA 50 crosses the longer moving average SMA 100 in an upward direction, and the intersection point must be below the price trend. Let's look at the following two examples. This is Yahoo Finance, FEC stock, and D1 time frame. Each candle represents 1 day of trading. The first condition is the trend must be upward, which it is. That's the upward trend. The second condition must be the price trend must be above the 100 SMA, which it is. The third condition is the smaller moving average 50 SMA should cross the longer SMA, 100 SMA, while going upward. And the point of intersection, which is this point, must be below the price, which it is. At this point is called golden cross. You have to enter the market, buy share here, and you have these shares all the way until these two moving average crosses again. This is the death cross, and you have to exit the market, sell your share. Now you buy share for $5.65 here, and you sell it for $11 after 14 and a half months. So basically you double your money in 14 and a half months. Let's say if you buy 1,000 share, you pay 5,650, and after 14 and a half months, you sell it for 11,000. This is Yahoo Finance, Air Canada stock, and H1 time frame. Each candle represents 1 hour trading. This is for short time trading. The three condition is first, the trend must be upward. It is upward. It's upward. The second condition is the price trend must be above the longer moving average, which is 42 here. And the last condition is the smaller moving average SMA 10 should cross the longer moving average SMA 42 in upward direction, which is true at this point, and this cross section is below the price, which it is true. So this is at this point you buy share, you enter the market, you have these shares until these two moving average again crosses each other at this point. Then at this point you have to sell your share, exit the market. So from this point the price is 16.74, and here when you exit the market the price is almost $20. So you make $3.25 in basically 8 days. Now if you buy 1,000 share, in 8 days you make 3,250, which is a very good money. Important steps required to exit the stock market using SMA 50 and 100. First, the trend must be in downward direction. Second, the price chart must be below the slower moving average SMA 100. And finally, the shorter moving average SMA 50 crosses the longer moving average SMA 100 in downward direction, and the intersection point must be above the price trend. Let's look at the following two examples. This is Yahoo Finance Air Canada stock and 1D time frame. Each candle represents 1 day of trading. The first condition is the trend must be downward. It is downward. The second condition is the price must be below the longer moving average. It is true. That is longer moving average. And the last condition is the smaller moving average, SMA 50, should cross the longer moving average, SMA 100, while going downward. It is true. The point of intersection must be above the price. It is true. This is the point you have to exit the market. And you should not buy share until the two moving average again meet each other at this point. Now let's see if you have 1,000 share. The price here is $40.26, and here is $16. The difference is $24 within 5 months and 6 days. And if you forget to exit the market at this point, you lose $24,000 in 5 months and 6 days. This is Yahoo Finance Air Canada stock and H1 time frame. Each candle represents 1 hour of trading. Now the three condition is, the first one is the trend must be downward. It is true. The second condition is the price must be below the longer moving average, SMA 42. It is true. The last condition is the smaller moving average, SMA 10, crosses the longer moving average, SMA 42, while going downward. It is true. This is the point that you have to exit the market, and you should not buy share until these two moving average again meet each other at this point, crosses at this point. Then at this point you have to enter the market again. Now let's say you have 1,000 share. The price here is $18.72, and the price here is $17.38. The difference is $1.50. And if you have 1,000 share, and if you forget to exit the market here, you lose almost 1,500 within how many days? Within 11 days. So in order to be in the market, it is very important to exit the market at the right time. Attention! Moving average could be a good indicator, but there is no single technical analysis that is 100% reliable, and sometimes it gives false signal. So it is wisely recommended to use this indicator with other technique to compare the results and include the risk factor in your portfolio. If you like this video, thumbs up, subscribe to my channel, leave your comments. Thanks for watching, take care, and see you next time.